What a year it has been. Well, market-wise, of course. From January 4th, 2021 to Friday, December 17th, 2021, we've seen about a 25% increase in SPY and some of the other broad-based market indicators. Well, we've had some hiccups along the way, including that almost 6% decline back in September. Over the year, we've seen the markets melting up to new highs with minor pullbacks here and there, ignoring the September big decline that we saw, but overall strength until what lies ahead is starting to rear its head. We see inflation at near 39-year highs. We know the Fed is going to stop the bond purchase stimulus and is poised to start increasing the interest rates much faster. What are the effect of the spending plans might be, or the effect of no spending plan as we wake up here on Monday, December 20th? We're still seeing supply chain issues and much, much more, leading to inflation and other problems, and also looking at COVID variant surges across multiple countries and even here in the US. In other words, going forward to 2022, we face the unknown. We have uncertain markets ahead. May we see a return of volatility and choppy trading? May we see a continued melt up after things settle down a little bit with some of those small pullbacks? Or are we poised for a larger correction due to fears of the inflation, variance, and more? It's a tough unknown to read, and we're all trying to read it. You might be repositioning your portfolio right now, taking off some of the profits that you might still have even with the decline today on December 20th, and looking to reallocate funds for 2022. You might be looking for the new stocks or the new sectors, new trends that appeal to you and appeal to how you think the market's going to go forward in 2022. You may still be sitting on large unrealized gains on core holdings in your account. Many stocks are much higher up in price over 2021 than the 25% of the broad markets. But maybe you don't want to take a tax hit right now, and you want to hold on to those core positions because you feel they're going to be strong going forward into 2022. Of course, you may be just managing recent short-term positions that are taking a big hit today. Now, shouldn't those new positions going forward have a locked-in controlled risk, giving you little or nothing to fear of the unknown, unexpected earnings surprises, or anything else that could rear its head in 2022? But in a structure that would do that, but also leave the upside open for further gains and still being able to get income to lower your cost basis and lower your risks. We honestly feel they should, and it's easier than you think. But let's take a look a little bit of what might have happened over the last few months, starting off with that September decline. Let's take a look at Berry Global Group. This is an actual trade in our Fusion portfolio at radioactivetrading.com. The worst potential price to get into this stock prior to that 6% decline in September was around September 2nd. The stock was trading at $68.66. Now, the close on Friday, December 17th, was $68.88, but that's a gain of 22 cents over a 3.5-month period, or just 0.3% on a stock hold. Well, there's ups and downs in there, but if we look at that, we might just say, oh, it's a stagnant stock, so a covered call might be a good approach. We can get income, increase the profits, and maybe even have profit with no gain in the stock, assuming it stays around the same price. But is that really how this strategy works? Using the historical tools and power options, we can see on September 2nd, 2021, we could have bought the stock at $68.66 and sold the out-of-the-money September 70 call for about 58 cents. It's only about 0.8% a time premium, but we could have had a 2.8% return if assigned if Berry was above 70 at expiration. To be a little safer, we could have sold the 17th September 67.5 call slightly in the money for $2.20. Gives us about a 3% downside protection. You can still make 1.5% in 15 days if Berry remained above 67.5. But naturally, we saw September was bad. These would have been the reasonable at-the-money covered calls to sell for this particular stock. But The stock fell down to 61.05 on September 17th. That's down 11.1% from where we purchased at 68.66. Covered calls gave us some protection, with a slightly in-the-money call only being down 8.1%, and the out-of-the-money covered call being down 10.3%. And the following Monday, the stock opened even lower at $60.68. So let's say we allowed the calls to expire, and on September 20th, we were looking to sell the October series in a panic. We want to get some more premium to help hedge the losses we have on these positions. Well, at this point, the only strike that makes sense is the October 62.5 call. We could get about 93 cents in premium, gives us some upside room to 62.5 for the current price of 60.68, and we get about 1.5% against the current cost basis. Selling the 60 strike, if it stays in the money, would risk locking into a loss. And at the 65 strike is too little premium of only around 30 or 33 cents. Remember, our cost basis would be somewhere between 66.46 or 68.09, depending on which September call we originally sold that just did expire worthless. So we know in either situation, if we do get assigned in this case, we're going to be assigned and locked in to a loss, but we're playing defensive. Let's say we did take the lower strike. On September 2nd, bought stock at 68.66 and sold the 67.5 October strike for $220. That call expired on September 15th, so we lowered our cost basis down to 66.46. Now, on September 20th, we're going to sell the 62.5 October call and get about 93 cents of premium. This does put us into a potential locked-in loss of about 303, or minus 4.6%. We're going to have to be diligent and look to move that call if Barry starts to rise above 62.5. But keeping it simple, let's just say we held it to the 15th of October expiration. Barry closes at 63.52. What are our choices? We could take assignment and lock in a loss of 4.6%. Well, I'll be honest, that beats the 8.3% loss we would have seen in September if we just got out of the position when our call expired. But we did sell the 62.5 call for 93 cents. We're going to have to add more premium in to stay in this trade to try to get back to break even. Buy it back at 105. So where do we stand? Originally bought at 68.66, kept the full 220 premium from that September call, got in another 93 cents by selling the October 62.5 call, but then we had to buy it back to avoid getting locked into the loss of 4.6%. We pay another 105 in. Cost basis on the stock is 66.58. It's the same as essentially being assigned, but right now we have an unrealized loss with the stock at 63.52 of 4.6%. So we wait till the following Monday. Barry's hovering around 63.60. We've got a cost basis of 66.58. We could sell the 62.5 for 285. That's not really going to get us what we want here. We're still going to be locked into a loss on the position. The 65 for $1.58. Well, that's kind of interesting. It would knock our cost basis right down to 65, right at the strike we're selling. Perhaps we could get out of November at just break even. The 67.5 might be okay, only taking in 75 cents, but gives us more upside. We're not really getting back to break even. On November 19th, November expiration, Barry closes at 65.51. We have a choice. We could get assigned and essentially have no loss minus any commission fees we've paid into these transactions. We could buy to close our 65 November call for around 55 cents and then maybe look to roll to a December 67.5 or maybe the 70 strike. We've been in this covered call trade for 78 days for no gain or no loss with the covered call approach, and the stock is down 315 or 4.6% from when we initially entered the position. Let's pay that extra 55 cents, but wait so that on the 22nd of November, Barry's up at 66.53. We know our new cost basis was 66.58. We got $1.58 for that November 65 call. But we had to pay 55 cents to buy it back. So now our cost basis is 65.55. We could liquidate on Monday, the 22nd of November. Now the stock's moved up to 66.53 for 98 cents of profit, or a 1.5% return in 80 days. Or with this cost basis at 65.55, what about selling the 17th December 65 call for 225, giving up a little bit of intrinsic value, but our new max return would be 170 if we were assigned at December expiration, or 2.7% for 106 days of time. And that max return could have happened. On December 17th, Barry closed at 68.88. We would have been assigned on the 65 call for that 2.7% return. The cost basis had lowered down to 63.30, but we're giving up our shares at 65. It only took 106 days in uncertain markets. But that's not meeting your target goals, is it? You're probably looking more to make 2% or 1.5% per month, maybe 0.7 or 0.8% per week with this strategy. And this type of management that extends the time in uncertain markets would be the same for cash secured puts, naked puts, or wheel approaches. Was it the fault of the market, or was it the fault of the structure of the trade? The faults of popular option trading structures: cut your winners short and cap the upside gains while leaving the downside open to further losses. Not even a stop loss can help in some uncontrollable declines. Then there's the allure of high premiums and high returns from highly volatile positions, which usually ends up resulting in large losses. Don't we typically want the opposite to be successful in the market? Wouldn't we rather cut the losers short and let the winners run? Flip those popular strategies on their sides, whereas covered calls, cash secured puts would cap the gains, but leave the downside open for extended losses in uncertain markets. Wouldn't we rather cap the risks, keeping the risk to single digits, guaranteed single digit risks, unlike a stop order, which is just assumed insurance, but still leave the upside open, but not necessarily using a leveraged long call position, which carries 100% of what you invest in the position, actually controlling it to single digits. And on a day like today, the Monday Doldrums, it always seems to be a Monday, doesn't it? Yeah, well, sometimes it's a Wednesday. Sometimes it's the last hour of Friday. Sometimes it's a random Thursday. The market just opens up down 1.5% to 2%. Now, I'm holding one stock that's down 3.2% today. It's down about almost 7% since I entered the position. Another one is down 3.5% today. But following the rules in the blueprint and flipping those popular structures on their side, both positions are bulletproof right now and have no risk. You have a guaranteed profit to the downside with still time to make adjustments to increase that guaranteed exit. And if a massive rebound does happen, we still have our upside open over the course of maybe 2, 3, or 8 months remaining in these positions. Now remember that first cycle of the Barry covered call. If we had bought the stock at 68.66 and sold that September 67.5 call for 220, with the stock down to 61.05, we'd be sitting on a loss of 8.3% after 15 days. It would have been 10.1% if we'd used the speculative out-of-the-money call and only got 58 cents as a hedge on the position. And as we saw, it took us 3.5, 4 months, might have even taken us 7 months to get back to break even, depending on the movement. So what if we did flip that script, and instead of capping the gains and leaving the downside open, we capped the downside to a guaranteed limit and leave the upside open? How would we have structured a trade, following the rules in the blueprint to enter a properly structured married put position? September 2nd, we would have bought 100 shares of Barry at 68.66, same as for the covered call, and we would have bought the 2022 March 70 put for $6. Now, yes, this does increase the cost basis to $7,466 for 100 shares, but I'm guaranteed, in the absolute worst case scenario, if I do nothing and hold this position all the way to March expiration, 6 months away, and the stock happens to be below 70, That's the only time I'd realize the full risk of $466 or 6.2%. That curved red line here on the profit and loss chart is showing you the halfway point, end of December, beginning of January from September, and the break even was right around $70 because the put doesn't go to zero when I purchase it. It's retaining its value. So in that first cycle of opening the trade on September 2nd to September expiration, remember Barry was trading at 61.05, down 11.1% from our worst purchase price. The two covered calls, the one we used in our example, would have been down 8.3%. Using the out of the money call would have been down 10.3%. The married put was only down 4.9%, about half of what we would have seen with the out of the money call, and only about 2/3 of what we saw using the slightly in the money covered call for better hedge. The stock was at 61.05. The March 70 put was around 9.90. If we liquidated the position, we would have got $7.95 back. The total cost was $74.66. We only would have lost $3.71, or 4.9%. And that loss in the October series was lower as well. It was only a loss of about 3.7, 3.8% compared to 4.6% for the covered call. Now, that also assumes using no income methods. What are the income methods? The blueprint teaches 12 ways to generate income, lower risk, and potentially bulletproof the protected trade. Now, why are there 12 adjustments when usually in a covered call you only have 2 or 3? Well, some are for bullish markets. They work best if the stock moves up after you've entered the position. Some are for bearish turns on the stock where we could still get income, lower our break even, or convert the position to a winning trade in the opposite direction. And some of those 12 income methods are used if the stock is stagnating. Well, I am in a stock position with a protective put, so I still could have sold calls against it, as we do with the covered call. But I have a floor at the base of my position where I don't have to make up 8%, 10% declines in my underlying. Income method number 1, selling a call in the proper structure. We could have lowered the cost in September right away, again in November when the stock moved up, and December, potentially having the opportunity for a similar 2.7% return, but guaranteeing a lowered risk of only 2.4%. But remember, that's the March put, so I could still do other actions in January and February and possibly March as well to have no risk on that trade and still take advantage of income and further upside. We could have taken Barry from low risk to no risk by manipulating the put option. Remember, it didn't go to zero. It's a second working asset in the structure, unlike a covered call where the most we can get is the premium we receive. As the stock fluctuates up and down, we can manipulate that put in different ways and potentially bulletproof the trade, taking it from low risk to no risk, just like the Ally and ESI position in the Fusion portfolio. Or I potentially could have had a profit in September by using a different put manipulation. Maybe would have had a small profit on September 17th or September 20th, potentially with a break even around 61.30 to the downside. So even though the stock was down 11%, I was still long the stock. We could have potentially seen a profit using one of the income methods. We're going to share more of that with you later this week as well. But that is what is in the blueprint, the proper protected structure to force an ideal size trade and stack the market odds in your favor. The whens and hows to use all 12 income methods to help you further lower that initial low risk, generate income to increase profits, and potentially bulletproof your trades. There's also full chapters on combining income methods, a full chapter on when to exit the radioactive married put trade, and full appendices, and much, much more. And now, of course, is the best time to pick up the blueprint. If you've been considering the blueprint, or you want to go forward into 2022 in uncertain markets, controlling your risk, having the ability to still generate income and lower that initial low risk, withstand the uncertain markets and more, with our special end of the year bonus offer, you can receive these 8 bonuses if you purchase the blueprint before December 31st. You can head over to radioactivetrading.com and go into the store, or just go to radioactivetrading.com/EOY for other information. The various bonuses you receive, you can have 2 discounted months of the Fusion subscription, which will give you access to various lessons, ability to follow trades, and other members-only education. You'll receive one of the Mastery Series videos, the Forts video, completely free. You also get an additional video, the 4 Insiders Secrets of Trading, or FIST video. We'll send you a quick start guide to help you get started faster, and also 1 month of power options for free. You can take that whenever you're ready. It only starts when you first log in. You'll also get instant access. The blueprint is now an all-electronic copy. No shipping expenses, no waiting for arrival. You'll get instant access to our educational portal at learn.powerop.com. Of course, you'll also receive email support for free and instant access to members-only content. But again, this special offer ends December 31st at midnight. Get access to your copy of the blueprint and be prepared to go into 2022 being able to navigate uncertain markets with the proper controlled structure, proper use of adjustments and income methods, and potentially bulletproofing your trades going forward.